All right. Well, thank you everybody for joining us today. And this is the second in a 6 webinar series that we're doing for centers throughout Vermont, as well as anybody else that's watching that's running a nonprofit. We look forward to talking with you. And my name is Michael Lee. I'm CEO and founder of Reconciled. And we've been partnering with ADAP as well, the Center for Health and Learning, where Gwen works, on these series of webinars to provide the centers across Vermont with tools as you run your centers and how to do it better, hopefully more efficiently, as well as throughout the challenges of the pandemic that has occurred over the past year, as well as continues on this year. We have our speaker and lecturer today, Megan Tarnow. She is a consultant with Reconciled, as well as a specialist in nonprofits. And so you saw her on the first webinar we did, and she is going to be doing this webinar today, preparing for an audit for nonprofits. So looking forward to hearing from Megan and her expertise. Of course, if you have any questions that pop up, if you're on live, feel free to answer the or ask the questions in chat, or even raise your hand. No problem. We'll be able to respond to those. And I will be having my video off, and I will be letting people in that join us late as well. But don't be shy, and I may chime in to remind people to ask questions or to raise their hand if they want to ask questions. But feel free to use the chat window as well, and we look forward to that. And you will be receiving a poll after this webinar. And if you're watching a recording of it, we'd love to send you the same poll, or just to get your feedback on it in general. So feel free to send feedback to me directly, as well as to Gwen if you wanted to receive some feedback, and we'll get that over to both myself and to Megan as we develop more of these webinars together. But without further ado, I'll turn it over to Megan to introduce herself and to start into the topic.
All right, let's do it. And so, Michael, I appreciate that you're going to hang out and I can at least have somebody I can look at and feel like I'm talking to, because the whole, video Zoom webinar, thanks, Gwen, can be a little weird, right? So it's nice to know that there's actual people that we're talking to. And because it's not a huge group, we can pause and we can grab things as we have questions. So I have to warn you, I love this cartoon. We're going to audit all the things, even though in Vermont you are not required to get an audit. So you're just doing this for fun, or because you reach the single audit threshold, or because you want your funders to have that extra layer of confidence. I'm going to warn you, in some ways it's a very bullet point heavy topic. So I have added completely unrelated images of animals, just to give us all something to look at. This is me. Michael already told you a lot about me. I saw you last time. I am still an advanced certified QuickBooks Pro advisor, and I work exclusively with nonprofits. I was telling Michael, I love talking about audits because many of my early clients were actually referrals from an auditor. I started working with a client. They had an audit later that year. The auditor came in and said, holy cow, this is not nearly as messed up as it was a year ago. What happened? And started referring his problem clients to me going forward. I was lucky that he was sort of, in some ways he saw himself as a training auditor. I think there's a couple different ways that auditors work with clients. I think he happened to work with a lot of small nonprofits that were just working their way up into needing audits. And so he was a great trainer. He would take the time to explain what he was doing and why he was doing that. That's not true of all auditors. Very often, if you're working with larger, particularly national or international firms, they seem to come in with almost a punitive attitude, like they are waiting to catch you out. So let's talk for a second about what the audit isn't. I think there are a lot of misconceptions, at least with the smaller nonprofits I used to work with. It's important to realize that the audit isn't for you, even though you're paying for it. The whole point of the audit and the intended audience are the public at large, the government, if you're having a single audit, and also other potential funders. They want to know that you are doing things the right way and that the money that they are investing in your organization is going to be well used. An audit is not going to uncover fraud in your organization unless you specifically engage the auditor to do that. That's simply not what they're looking for. It's probably not going to catch inconsistent coding between accounts or programs. We tend to spend our time looking at the income statement or comparing our budget to our actual, and yet the audit is focused much more on the statement of financial position, which a lot of times we don't look at as often as we should. And the audit isn't supposed to tell you what your numbers should be. I had a lot of small nonprofits that would not track any of their restricted funds and would just wait for the auditor to tell them what the balance was at the end of the year. That's not helpful. It doesn't help management. It's our job to present the financials and theirs to make an opinion on what they say, which is exactly, what is an audit? The purpose of an audit is for your auditor to form an opinion on whether the information presented in your financial reports, taken as a whole, reflect accurately the financial position of the organization at a given date. So the financials belong to us. The opinion belongs to the auditor. Their job is to say, in some ways, to sit in judgment and say, do these financials reflect accurately the position of this nonprofit? Can we trust them that they're doing the work they ought to be doing? And then based on those numbers, how do we feel about their ability to survive and thrive going into the future? We'll find that the auditor is a lot less concerned about the details of your income statement than they are in looking at variances year over year. So that's something we're going to recommend that we get out ahead of and look at prior to the audit. They're going to be really interested in confirming the details of your balance sheet accounts. Not just your bank accounts, but all of the different accounts you may track on your balance sheet. They're also going to review your policies and procedures, and they're going to check to see that they were followed. And the point there is that they are looking for areas of risk, right? If I, as the government, if I, as a foundation, am going to engage with your organization, essentially invest in your operations, I want to know that you've taken the time to understand not just your programming, right, but also the processes you need to have in place to be well run financially, and that we didn't just write up those policies and procedures, we're actually following them, and we've considered where risk might occur in our organization. And this is the super heavy, it's like one slide that has all of the things on it. How to prepare for your audit. I think my first and strongest recommendation is not to wait until year end. The things that you're going to put in place are things that you should do on a monthly basis. Or if you're super busy and you're run entirely by volunteers, at least on a quarterly basis. You don't want to leave it all go and then try to catch it all up right at the end. Document your processes. Look for areas of risk. Are there places in your organization where a dollar flows all the way through and only a single person touches it? That can happen in small organizations, right? We just don't have the bodies for separation of duties, but we need to consider where are the places that fraud could occur in our organization and what have we done to mitigate that? So whether it's having our mail sent to a lockbox box at the bank where they're opening the checks and depositing them right into the account and sending us a report, whether it's creating a log of checks where one person opens the mail and another person goes to the bank. Controls around vendors. That's one of the huge areas and tools that not only make our lives easier in terms of working remotely, like Bill.com or Fintanium, other accounts payable apps that allow one person to enter the vendor and the separate person to be entering and paying the bill. Common areas of fraud, right? Or someone creates false vendors and sends in false bills and pays them. Having more than one person look at those transactions and, raise the flags. Do we know who this vendor is? Do we have a contract on file? Have we seen the actual source documentation? Does it look legitimate? That's one way to limit risk. And so the auditor is really going to be asking, where do you imagine there is risk in your organization? And what have you done? And the answer is going to be different based on the size of your organization and the resources you have available. But even having done that thought process where you've taken the time to, write down, these are the places we think things could happen, and here's how we're taking steps to prevent it. Another great separation of duty and sort of check in that area, even if you're a very small organization, is to have your board treasurer review the bank statement. Have that bank statement go to somebody else besides the bookkeeper and have them review and sign off on it, because they're going to notice if something's fishy. There's a great book that was referred to me, a friend referred to me, called Diary of a Bad Bookkeeper. And it's only about 75 pages long. And it's all the ways that a nefarious bookkeeper could create fraud in an organization. And in many ways, the answer and the way to solve it is reviewing the bank statements, because that way someone else would notice when things are going awry. Then we want you to review I'm anal about this. I review all of my balance sheet accounts on a monthly basis. So I'm reconciling not just the bank accounts, but I am reviewing and tying out my receivables. And I think all you guys, when we talked last time, we're using QuickBooks. A lot of people will run the accounts receivable aging summary. There should be nothing with a 0 on it on your accounts receivable aging summary. There should be only line items that actually have numbers. If there's a 0 on that report, it means that there was a receivable created and a payment received, but the two pieces have not been pulled back together. And so you need to go in and receive payment to make those things connect. It's also really helpful, I think, to review the open invoice report, because that will show you all of the details that make up the summary. And you can look at that and go, does it make sense? Does that line up? Are these the people who owe you money? Is that collectible? If there's stuff sitting on that report from 2014, let's fix it. Let's deal with it and get it out of the way, right? Look into the details of your prepaid expenses. I find that prepaid expenses tend to be a real black hole in a lot of people's data files. You drill into that number and you can't tell what the heck makes it up. And one really easy way to keep an eye on that is to make sure that every transaction in and out of prepaid expenses is assigned to a vendor. And then you can drill into the prepaid expense account from your balance sheet and group that report by vendor to see exactly what's making it up. I will also remove any columns that I don't need and set a filter to show me only uncleared transactions. And anytime a vendor, the expense both goes into prepaid expense and goes out again to my income statement, I'll reconcile that prepaid expense account to zero. And I will check off and reconcile, the debits and the credits that balance each other out to keep that current prepaid expense report clean and usable. I also, I have some people that like don't worry about prepaid expenses until year end. Like they'll go and they'll expense their rent on a monthly basis. But in December or at the end of their fiscal year, they'll suddenly switch and put it into prepaid because they've been caught by the auditor on that before. I find it's easier, at least for me, because we've all got a lot of on our minds. We're all very busy. It's much easier to have a process that you do consistently all the way through the year, as opposed to a process that you only do at the end of your fiscal year when you're preparing for an audit. So I keep an eye on my prepaid expenses. If I'm paying my rent before the first of the month, that's always going into prepaid and then being expensed on the first. Same with health insurance, same with other kinds of insurances that we pay all at once and then expense and use over the course of the year. You want to be sure you're capturing additions to fixed assets. Know what your capitalization policy is. I mean, I've seen some people capitalize like a coffee maker. Like that's a $35 item. Let's not be putting that on our fixed asset schedule. Come up with a number that is sensible for the size of your organization. If you're small, it might be $500. If you're larger, it might be $5,000. We've got a lot of clients who actually have a section on their income statement for capital purchases because these are tricky when we're budgeting. We know that we need to spend that money, even though it's going to later on show up on our balance sheet. So we've got a section where capital purchases can immediately be expensed there and show up and track against a budget, but with a contra account, a reverse line that is transfer to fixed assets. And so we want that section to zero out. We've got them there for budgeting, then we move them to the balance sheet. Fixed assets and depreciation are probably something that you will keep an outside spreadsheet on. So you can show the cost, how much you're depreciating each month or each year, and making sure that those numbers on that schedule tie to what is actually in your books on your statement of position. It can be helpful to record depreciation on a monthly basis. So you spread that out over the course of your 12 months instead of having it all end at hit at the end of your fiscal year. Think about on that one, just consider how it's going to present on your other financials. Just like we reviewed and tied out our receivables, we want to do the same thing with payables. Same story, if you run an AP aging report, there should be nothing on there with a zero in the total column, because that means that a bill and a payment exist, but the two things were not tied together. That can happen if you have someone who's doing a lot with journal entries rather than using the forms in QuickBooks. So the total on your statement of activity is correct. It's total on your statement of position is correct, but those details, right? Those detailed reports that really allow you to manage your organization can be full of just garbage. Look for other things I see in there. I see old bills, right? Probably what that means is if I've got a bill that's sitting there, I may have recorded that expense twice. I entered a bill and then I did just an expense form. So I've double counted whatever the expense was. Sometimes I see audit journal entries in there too, right? Because the auditor is just going to give you a journal entry that makes the trial balance work. They won't necessarily think about what the impact on the details for you. And so you don't know what that's about. And it stays there. And the next year, the auditor does another adjusting journal entry, and those pile up year over year over year. We've seen some real messes hanging out in accounts payable as well. If you're being audited, chances are good you're on the accrual basis. So the auditor will be looking for expenses that were incurred in your fiscal year, even if the bill did not come until later. So be on the lookout at the end of your fiscal year for, folks that may wait to invoice you, right? If the work was actually done during your fiscal year, you're going to want to accrue that expense in advance of the audit. You're going to need to justify deferred revenue. And I'm seeing auditors really spend a lot of time on revenue at the moment, really because the revenue recognition rules changed for fiscal years starting after December 31st, 2019, right? We went from 3 net asset categories down to 2. And then there became this, I'm bad at the numbers, I think it's ASU, it's either 2016-14 or 2014-16. One of you guys might know for sure. But the one that, there's now this huge decision tree on income, where we have to decide, is this a contribution or is it an exchange contract? And historically, most of us had treated any kind of government grant or contract as an exchange. The guidance has come back and told us, nope, the government itself is not receiving the benefit of those dollars. It's going to the public at large. Therefore, those need to be treated as contributions. But very often, they are conditional, right? So that's the next step. Once we determine whether those dollars are an exchange contract where the person paying us is getting the benefit, or a contribution where the benefit goes to the public at large. Next step is to decide, is that contribution conditional? Are there specific things we have to do in order to get this money? Is there a strong right of return? They've come back and said things like, oh, you have to do a final report is not really a condition, right? We're guaranteed that money. But if it's one of the grants that I think you guys have a lot of, where they really are almost reimbursement grants, right? You have very specific things in your budget you have to spend the money on. There's an admin component. They may give you some money up front, but you have to invoice for that. That would be considered a conditional grant. And none of that revenue would get booked until you've earned it. You've met the conditions. So that distinction sometimes between a restricted grant and a conditional grant is in the eye of the beholder. So what your auditor is going to be looking for is your documentation of how you applied the guidance and came to the decision that you made. So I'm seeing a lot of that right now. And people are having to spend, it's nice to do that as you go, have that conversation with any new grant contract that comes in, because otherwise I'm seeing people having to go back and do that retroactively, and it's really taking a long time. And then if you have restricted grants, whether they are restricted as to time or as to purpose, you're going to want to go back and document all of that. When did the grant come in? When were the restrictions met? What is the current balance of each of those restricted grants? Once upon a time, and I still run into this, even though this has not been GAAP since 1993, I still run into occasional nonprofits that book restricted grants directly to their net asset accounts and only show them as revenue as the restrictions are met. Not okay, not GAAP. If it's a restricted grant, it does not go to a liability account. As awful as that is, we have to track all of that as income when it's promised, and then release restrictions as those restrictions are met. And I'm just going to sip water here because I'm apparently losing my voice a little bit. It is allergy season kicking off in Minnesota. We're happy about that, but you guys might be having that too. Another thing you can do is gather all your source documents. I think that's one of the wonders of QuickBooks Online, if you're using that software, is just how easy it is to attach documents directly to transactions as we go, and to give the auditor, if they're willing, access to our QuickBooks Online file. Then if they have a question, they can just like click right into the source document. And we're spending a whole lot less time running around trying to find the paperwork, scanning it to them, right? Because right now during COVID, I'm seeing a lot of auditors who have made the move to remote audit, and they may not go back, right? It may no longer be the auditor comes and sits in your office for a week while they do your audit. It may be more and more these digital portals where we're just uploading the documents that they're requesting. If you're already saving them digitally, I think a huge thing is to be sure you're naming those things consistently. That's one of the issues with digital file cabinets, right? People can just drop things in wherever they want, and there can be a lot of consistency. So taking the time to come up with your folder structure and your naming protocol, and ensuring that everyone in the organization is naming and filing things the same way, is going to save you a lot of stress and a lot of hassle. We have ended up in our firm going to almost like a year, I don't know if that's a European presentation, but like a 4-digit year and a dot, a 2-digit month and a dot and a 2-digit date, so that when things are chronological, we can just see them. Everything lines up from oldest to most recent. And that saves us a ton of time. I'm going to pause at this point and just see if anybody has questions or comments where we're at right now. Michael shaking his head no. Gwen says maybe. Yes, ma'am.
Megan, you mentioned something. I think you were talking about accounts receivable. Watch for things that are not invoiced yet, accrue before the year end. Was that on
payables? Oh, actually,
payable.
Both actually.
That was accounts payable?
It was, but it applies to both, right? So if you have a reimbursement grant where you've done the work, you want to accrue that income by the end of the year as well, even if you haven't sent it.
I see it on the accounts receivable side, but on the accounts payable side, how do we assure, because on the accounts receivable side, we're generating the invoice. On the accounts side, does that mean going out to your people you're expecting invoices from and getting them to submit their invoicing?
It would be lovely if they would do that. Otherwise, you know, often you'll have a pretty good idea. And again, this is something that, like, I wouldn't worry about something, you know, $100, but for numbers that are material to your organization, like if you had an event in December and you haven't gotten the catering bill yet, you've probably got a pretty good idea of how much that's going to be. And that's one of the instances where I would use a journal entry and just put it to other accrued expenses, so that on the first day of your next fiscal year, you can reverse that and enter the bill under your normal process.
Okay. All right.
So big things I think would be like those kind of events, or, you know, major contractors who maybe didn't send you their bills yet.
Yeah, got it. Okay.
Yeah. Everybody else is still on mute, so I'm going to click over. There are also special considerations. There are certain things that I think only need to happen at year end. At the end of the year, if you have uncollectible amounts, you're going to want to calculate and record an allowance for any uncollectible receivables. That can be based on your history and your experience, sometimes you invoice the government and for whatever reason, they don't pay you everything. I see that a lot with people who do insurance billing, to get some sort of an estimate of what is actually collectible. And again, that's a journal entry that can be reversed in the new fiscal year, and those receivables can follow your normal process. I recommend that you calculate and record a net present value for any long-term pledges. So this is grants or pledges that are not due in the next 12 months, estimating essentially inflation over that time period. Check with your auditor and if they have a recommendation as to the method you should use for that. I had to do it recently, and they recommended essentially looking at the interest you would earn on a CD over the same time period as the receivable is out, and using that as the percentage for that net present value calculation. One that catches me up, and I've got caught on before, is watch for prepaid expenses that are also on your payables report. So in an insurance bill that would be prepaid, but you haven't actually paid it yet, and do an adjusting entry to zero that out on both sides, because that's something that the auditor is going to watch for, or at least they do for me. Maybe they're just running out of things to catch me on, so they're getting more persnickety. Accrue any unpaid wages and taxes. So for example, if your most recent payroll was on the 28th, but that paid people through the 25th, the 25th through the 31st, you're going to want to calculate and accrue those wages and any associated employer taxes. Review and adjust any of your PTO balances. So for both PTO and accrued wages and taxes, I tend to let that sit there. So I will accrue it at the end of the year and not worry about reversing that out and calculating on a monthly basis. I tend to let it sit and just do that calculation at the end of the year and make an adjustment for what the prior year was, because it does seem to be reasonably consistent and immaterial in the day-to-day operations for most organizations otherwise. Same with PTO, although if you have a lot of it and that skews your financial picture, you may choose to review and adjust that more often. And then this is the time that you want to be sure that all of your fixed assets are depreciated and any shared costs are allocated across your programs, admin, and fundraising, so that we can get that true statement of functional expense. They also ask for a lot of non-financial information on the audit. And again, they're looking for those process and procedure. So they're going to ask for any board or committee minutes, particularly those that have any sort of financial implications. So making sure those are ready and accessible. They will want to know any changes to your bylaws, any changes to your internal policies. They'll ask for documentation of any sort of legal expenses. They're going to want to know about all new agreements. If you have a new lease, a new contract, any new grants. I'm trying to think what else is always showing up. If you have disposed of any of your assets, they really want to know what has changed in the last year in regards to your organization, right? So it's great to have thought that through in advance and have an answer of what's changed. It's really easy as we're just, we're going through and we're doing the work, and, last March feels like a lifetime ago, not just 12 months ago, to go, okay, we did enter into a new contract last February. Forgot about that one, because we've had a little bit going on in the meantime. So, even like go back through your calendar, go back through your own board minutes to see if there are things that have changed that would have an impact. They're also going to ask you has anything impacted your business in this year? And I keep laughing like, well, there was this COVID thing that had an impact. I'm in Minnesota, so the impact of the murder of George Floyd was huge and disruptive for a lot of organizations here. What else is happening, in the nation, in your state, in your town, in your organization that might have any impact on your financial picture this year or going forward? They're going to ask for your W-2s and your W-3 so that they can tie that out and your 1099s. They're looking to see that people that should be employees were in fact employees and not contractors, and that you're doing all of the things you're supposed to do. You're submitting your payroll taxes, not just withholding them from employees, right? That's another place where organizations can get in trouble when money gets tight. So it's a place where the auditors focus attention. And then I recommend that you prepare your own statements, right? We said before that the financial statements belong to you. The opinion on those statements belongs to the auditor. So within certain guidelines for GAAP, you get to decide how those numbers are presented to the public. And you want them to tell, to the best of their ability, the story of your organization. So one place to start is to review the prior year's grouped trial balance. That's where the auditor takes your entire chart of accounts, kind of bundles them into the things that they show on the audited financial statements. Don't just take their word on that. Every once in a while, you have an account in your chart of accounts that means something very specific to you and may not mean that to the auditor. So they can put that in a place that doesn't make sense when you actually look at your financial statements. Review your budget to actual. If there are big variances between what you budgeted and what actually came in or was spent on a particular line item, take the time to drill in and understand why those variances occurred. Was it external forces? Did you get a big contract you didn't anticipate? Were you just bad at budgeting last year? Why are those things, why are there variances? Same story, run both your P&L and your balance sheet for the fiscal year you're reporting on and the prior year, and add that column for percentage change, because the auditor is going to be looking at anything that had, depending, a 10% or more variance from the prior year. And they're going to ask you, why did this change? You might as well get out ahead of them and understand yourself what happened. Did your payroll expenses go through the roof or drop? It can go either way. Maybe you hired a bunch of contractors because the nature of your business changed, or you lost employees and had a really hard time replacing them and you were just understaffed. There could be a lot of different reasons for the variances. It's just important that you know what they are. The other thing that's new recently is this statement of liquidity. I think that took place, maybe that got added officially on fiscal years ending after December 31st, 2019 as well. But what that is a new statement that's required in the audit showing what financial assets are available to fund operations over the next 12 months. So that's going to be actual cash you have in the bank, unrestricted cash you have in the bank, receivables that you anticipate coming in during those 12 months. It can also be deferred revenue that you think you will be able to recognize as actual revenue. It can be restricted cash that is available for use over the next 12 months to fund your operations. And it's helpful for, we can find some on the internet, but just take a look and draft that yourself. And it's also really helpful for you to know, like, what do we already have on hand? You know, sometimes people, and is any of that not available? I've got an organization where they have significant unrestricted net assets, but the board is requesting that virtually all of that be put into a board designated reserve. It's like, if your board's doing that, then you need to be really clear as how are they defining that reserve? What are the uses of it? You know, if you, like, really? Are they not going to let you access that if you need it? Do they understand what a reserve means, right? As opposed to just net assets available for operations. And that's it's just a good, in addition to being, you know, part of the financials that are yours for the audit, it can be a useful exercise to start to get out ahead of, you know, potentially some of the cash flow challenges like we talked about last time when we were doing budgeting. In order to make it go smoothly, give yourself ample time to prepare. Every once in a while, I'll run across an executive director or a development person who wants the audit, you know, wants the auditor there, I don't know, the end of January on a December 31st fiscal year end. And I'm like, whoa, that doesn't give us enough time. Ideally, I like to be able to completely close and review the first month of my new fiscal year, just so I can catch anything that might have slipped past me when I was closing December, right? Or closing the last month of the fiscal year. That might be a place where we see invoices come in from vendors that were for activity, and we didn't think to accrue that. We can catch it before the auditor does, because they're going to be asking about all of the bills and the payments that we've made so far in the new fiscal year. Take time to review the prior year's management letter, right? That's where the auditor lays out any concerns they have about the way you are operating, about your policies, about your procedures. Review that and document what you have done to respond to their concerns. Even if all you've done is a cost-benefit analysis and decided, you know what, we can't afford to hire an outside accountant. We're just going to have to deal with the fewer internal control, you know, the limited separation of duties with our very small staff. But we reviewed it and we got estimates, and this is the decision we made, so that they know that you took that management letter seriously. Be ready. If you're not ready, postpone the audit. You know, let them know ahead of time. Don't waste everybody's time. I see a lot of, because I see that happen, right? People schedule an audit and then start to prepare for it 2 days before the auditor is supposed to come. That'll drive everybody crazy. You know, take the time to get everything together and make sure you have adequate time. Ask your auditor for, they call it a, what do they call it? A PBC list, provided by client. And some auditors are great at giving that to you up front. Other auditors just seem to assume you'll know what they need. Like, ask them for that document so that you've got time to pull everything together in advance. Be available during the audit. Like, try not to schedule vacation or other meetings or things that will make you unavailable to the auditor. You want to be able to respond promptly to their audit requests. They've set aside a limited amount of time for you, and the more that they can accomplish during that time, when they are focused and completely attentive to your organization and your needs, there's less of that shift that happens when we get involved in something and then we can't move forward, right? That slows it down for them, slows it down for you. And your audit committee, or if you don't have an audit committee, a finance committee also has a role. It's recommended that they meet with the auditor before any work begins, so that they understand any changes that may have happened to accounting standards. right? And there's big ones right now, biggest changes in accounting standards for nonprofits that we've seen in almost 30 years. So it's really important that your audit committee is aware of those and the impacts they might have on your financials. They should let the auditor know if they have any particular concerns. You know, not for any of you, I'm sure, but sometimes you have this sense like, something just feels fishy as a board member. Don't assume that the auditor is going to catch that. They're not coming in to look for fraud. So be sure to let them know if you have any questions or about your processes, your procedures, and the way your financials are presented. Anything that feels funny. Consider going into executive session. So you do that without staff present. That way the audit committee can be completely open and transparent with the auditor. Actually, I recommend that boards get in the habit of going into executive session periodically so that that doesn't feel punitive to the staff of your organization, that it's just something we do. And we do it regularly so we have an opportunity to discuss if anything comes up. And then the audit committee will also meet with the auditor to review the draft audit, answer any questions, be absolutely clear on what they're seeing before that report goes to your full board. When you get your audit back and it's been approved, I would say you're not done. I would recommend that you understand the impact of any adjustment the auditor made to your financials. You know, again, we mentioned earlier that the auditor is just getting the trial balance lined up. You know, they want their reports to look right. They don't necessarily worry about the details and your ability to use the software going forward. So consider, they gave you a bunch of journal entries. Is a journal entry the form you want to use in QuickBooks? Is there a better form for you to use to capture that same information, but in a way that's more useful for you in using the software? Should that entry be reversed in your new fiscal year because it's already being taken into account during your daily process? Is the auditor doing reclassifying entries? Be sure you understand what those are and why they're making them. It may be something that you want to change your process internally around for the next year so that those don't exist. And then finally, confirm that your audited trial balance ties to your general ledger software. That's a step we seem to miss a lot of the time, and then errors roll forward and become an issue the next year as well. So make sure everything ties out. And then give yourself some time to reflect on the entire audit process. What went well? What went smoothly? Were there things that were difficult or uncomfortable? And what can you do to improve for the next year? What processes can you put in place to make sure the next year's audit goes as smoothly as possible and that your books are essentially audit ready all year round? And that's all I have. Questions, comments?
I don't have a question, but we haven't had an audit before, and but we're getting close to where we're going to need to have one. So I'm hesitant to go any further until I'm prepared, financially prepared to have an audit. So we're trying to put everything into place. So this has been really good. Is there a way I can get this slide available, or?
Yeah, I can export this. I'm using this tool that's kind of awesome called beautiful.ai, but I can export that to PowerPoint. And I've also got a sample, and I can send that to Michael, and I'm sure he can send it out. I've also got a sample provided by client list from that auditor I worked with right at the beginning, who does provide just beautiful documentation of what he's going to need.
You know, yeah. I just want to make sure I'm prepared, and you know, and where were we a few years? A few years ago, we were like small, and now we've just like, because of how things are going, it's just expanded and grown, and it's like I wasn't ready for it at all. It's like, you know, it's like, holy crap, you know, and so I know we're going to get to the point where we're going to need to do one, and so I want to make sure that I'm totally prepared in all ways before we get to that point. So
I think that totally makes sense to just, you know, set things up the way they need to go. So you don't have to reinvent the wheel. It's just the way you're already operating. I think that's super smart.
Well, some things we got to change, I can see, which is good to know ahead of time, right? So,
but, you know, I feel like, I mean, for years and still, I think every time I go through an audit, I learn something that I didn't necessarily know before. And then you know, absorb that and get better and track things more closely, or make the decision, you know, do that cost benefit analysis of this. Is this other thing they want me to track worth the time and the effort it's going to take me to track it? Or do I let that one, you know, understand that I'm letting that one go? I don't have anything in particular in mind for that, actually, but.
Well, thank you. I appreciate it. Be helpful.
Yeah.
Megan?
It's a Gwen come off mute.
I have a question. It's just a question about terminology. Like, our accountant uses the term financial review, and an audit really isn't used. Is there a difference between a financial review and an audit? And then there's the single audit, which is a much more extensive audit process.
Exactly. And yeah, all three of those things are different. So a review it's kind of like an audit light. Okay. They just don't go as deep, and they don't look at as many things. And they're just, you know, they're going enough that they can give an opinion, right, on your, but they're not going as deep as they would for a full audit.
And then a full audit is different than a single audit?
Yeah.
Is that the same?
They're similar. I know, Michael, speak to this because I've only done it once.
Yeah, a single audit generally focus on, for example, it could relate to a specific grant. And so you're doing an audit, you're having an audit done because there's a specific grant that requires an audit, but it's not a full audit in the sense of you're doing an annual full audit for the organization, because that's like a requirement you have as an organization for either board reporting purposes or bank reporting purposes. So that's different than like, an example would be you have a contract with the Department of Health and they require a single audit for that specific grant to occur after the grant period's over. So those would be the kind of main differences. And sometimes even that in that situation, the single audit is not truly an audit, it's a review. So it really is the requirement decision of the grantor of what they require. And then there's what your organization as a whole say is if you want to abide by a voluntary full audit that you do every year. And then we're, you know, obviously that's completely different than what the IRS nonprofit audit would be, which they rarely do because they've been understaffed as a tax agency in general. So they rarely do nonprofit tax audits in general. But so hopefully that describes that difference, Gwen.
Yeah, I mean, I was just wondering because the federal threshold is over the 750,000, but if that's made up of multiple funders, who's requesting the audit then? Is it your largest funder or?
If it's made up of multiple funders, generally, like they look at the threshold for one project, right, versus all of them combined, because and I guess we'd have the nuance of like, well, are they seeing themselves as combined funders under one project, or are they seeing themselves as individual funders on individual projects, right? So that's also the complication around single audits. But in general, single audits pertain to one specific kind of fund or grant over a period of time, and is not the equivalent of a full audit, which is something you would do voluntarily as a board for organizational reasons and reporting reasons, but it doesn't pertain to a specific person you're trying to report to. Yeah.
Right.
Thank you.
Well, we're at the end of our time. I want to thank everybody for coming, and thank you, Megan, for doing such an amazing job. And we'll have this recording uploaded. And also, for those of you that are live, we will Gwen will be sending a poll over for you to just give feedback on the webinar. We want to make sure we collect feedback from everybody every time we do these. So, but thank you again. Feel free to reach out. Both Megan and I are happy to answer any questions outside of this live webinar. So, but thank you again. Talk to you soon.